Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
The price volatility in Pinterest, pins, has been one of the most intriguing market actions we've tracked recently. The stock has been locked in a remarkably tight corridor, specifically, $26.08 to $27.36, particularly surrounding that mid-December triple witching expiration. We are seeing a stock that is deeply engaged in a fundamental transformation, betting heavily on AI-driven shopping and the game-changing TV scientific acquisition. Yet its market valuation remains stubbornly depressed.
And that tight range is fascinating precisely because it creates such a stark bifurcation. You have this long-term strategic promise suggesting a major re-rating. Yet the immediate market dislocation is it's undeniable. It's keeping the stock essentially glued to the floor.
Exactly. So the central conflict, therefore, is whether this persistent trading corridors, the $25 to $27 range, represents a temporary technical suppression, a deliberate zone of institutional accumulation, masked by market maker hedging, or if that price accurately reflects genuine market skepticism regarding execution risks and structural macroeconomic headwinds.
And I'm going to argue the latter. I believe the price is signaling that the fundamental structural issues are paramount and that the $26 level correctly prices in the immense execution risk management is facing.
And I'll take the other side. I'm arguing that the current price is fundamentally a microstructure problem. Technical factors specifically related to options dynamics are overwhelmingly suppressing what is otherwise fundamentally sound deep value. We are looking at an arbitrage opportunity created by mechanics, not a failing business model. My thesis really centers on that mechanical pressure. I see why you think the fundamentals are the primary driver. I do. But let me give you a different perspective. The weakness is both synthetic and, I believe, temporary. Institutional behavior suggests a synthetic floor has been installed, and the stock is just sort of waiting to be freed from what we call a temporary gamma trap.
Okay, before you dive into the forensics, for our listeners who might not track the specifics of options market mechanics, can you maybe define what you mean by a gamma trap and triple witching?
Yeah, absolutely. So triple witching is simply the simultaneous expiration of stock options, stock index options, and stock index futures, which happens 4 times a year. Leading up to that and immediately after, market makers, the banks and financial firms who facilitate these trades, have to hedge their risk. When massive options volume is concentrated at specific strikes, say $26 and $27, as it was for pins, market makers are forced to buy or sell the underlying stock to balance their books. This hedging activity acts like a powerful magnet, artificially pinning the stock price near those heavy strike prices to maximize their premium retention. That's the gamma trap. It's the mechanism of forced mechanical buying and selling that just neutralizes the natural price discovery process.
So the price stays artificially low because of contractual obligations, not necessarily because of intrinsic value.
Exactly. And the evidence of this floor is everywhere. We've seen concrete signs of massive absorption activity by institutions, specifically through dark pool forensics. Now, dark pools, for those unfamiliar, are private exchanges where large institutions execute massive trades away from the public eye to avoid market impact. We tracked a huge spike, a 137.55% change in dark pool inflow compared to the average, including specific high-volume prints like that 924,070 share block that executed right at $27.36. This indicates silent, aggressive accumulation. Smart money is deliberately taking advantage of the options-related suppression to load up discreetly.
I understand the allure of that quantitative evidence. I do, but I come at it from a different way. Those technical dynamics, while real, are merely amplifying a justified structural fear. If the fundamentals were truly robust, institutional interest would have overwhelmed that gamma effect. The market is signaling legitimate business issues that management cannot simply trade their way out of. We cannot ignore the macroeconomic reality impacting Pine's core vertical.
And what do you see as the most pressing macro issue there?
Well, it's the digital ad economy facing severe cyclical and structural headwinds.
Pinterest is heavily concentrated in the consumer packaged goods, CPG, and retail verticals. The specter of new tariffs or simply persistent inflation concerns has caused these massive clients to slash their marketing budgets. This macro hesitancy is the direct primary driver behind the disappointing Q4 2025 revenue guidance, predicting $1.31 billion to $1.34 billion, which was a clear miss. This fear started when they reported the Q3 EPS miss and, crucially, forecasted a sequential deceleration in revenue growth, dropping from 17% down to 14 to 16% for Q4. To me, that signals they are losing market share to competitors like Meta and Amazon during the most critical holiday season.
But doesn't the long-term strategy, the TV Scientific acquisition, address those macro issues by future-proofing the revenue stream?
See, that's where the market skepticism is highest. The acquisition is being described by some industry analysts as a flotation device because it is a defensive, a reactionary move. Pinterest is now entering a red ocean segment, the connected TV or CTV advertising space, which is already heavily dominated by giants like The Trade Desk, Google, and Roku. The integration risk is high, and the delayed timeline, not closing until the first half of 2026, means the market is rightly discounting those future cash flows, and that keeps the stock anchored to the present risks. The market is punishing that delay and the inherent execution risk.
Let's focus on the microstructure first, because I think the price signal is currently, well, it's polluted. The stock closed right at $26.08, which is just slightly below the $27 max pain price for that expiration. Max pain, to put it simply, is the price point where the greatest number of open options contracts expire worthless, maximizing profit for the option writers who are typically market makers. That proximity to me validates the idea of manipulation designed to extract maximum premium.
I hear you on the specific mechanics of max pain, but those algorithms only work when fundamental conviction is lacking. The low implied volatility, or IV, you cite, around 35.4%, placing it in the 10th percentiles for IV rank, suggests market complacency. But I would interpret that complacency as institutional fatigue. The analyst community's underlying fear is real, and it's fundamentally based.
But if the IV is that low, it often perceives a volatility expansion to the upside once the mechanical hedging pressure is released. It suggests the stock was deliberately, tranquilized.
That's an interesting point, though. I would frame it differently. While algorithmic pinning certainly creates turbulence, the $26 price links directly back to structural weakness, not just noise. Morgan Stanley, for instance, specifically voiced concern over PIN's limited advertiser diversity. This isn't a technical problem, it's a fundamental problem, stemming from that CPG dependence that gets hit by macro shocks like tariffs. If true deep value is recognized, the institutional buying you cited, that absorption you see in the dark pools, would have easily overwhelmed the max pain effect and broken the stock higher.
So you're saying that dark pool buying is a non-factor because it failed to move the needle immediately?
I'm saying it confirms accumulation, sure, but the failure of that massive volume to break the stock past $28 suggests that the accumulation is conditional. It's only happening because the structural headwinds are keeping the price artificially cheap. And we have a cautionary tale here. That large madman trade we saw, a reported $3.6 million purchase of $35 calls that ultimately expired worthless, it shows the inherent danger of betting solely on the technical release. The market has good reasons to be cautious about the next fundamental move. That trader clearly lost his shirt betting against the structural reality.
But that cautionary stance ignores the core of their strategic move. The management team is aggressively addressing the structural signal loss crisis, the deprecation of third-party cookies, and the Apple ATT changes, which you correctly identified as a primary driver of skepticism in the ad world. The $26 price point is a gift because they are fixing the platform's ability to prove ROI.
I'm just not convinced by that line of reasoning because the acquisition feels entirely reactionary. It suggests the core platform is currently losing its performance edge, forcing them to bolt on a complex new solution. It's a defensive move. And look at the current adoption friction. Only 29% of business owners currently consider shoppable pins effective. If they can't get advertisers to utilize their simple, native shopping tools effectively,
How on earth are they going to convince them to adopt a complex, expensive connected TV platform that requires integrating two disparate data sets? The market is rightly anticipating integration failure and friction within the sales force.
The urgency is absolutely warranted, but the acquisition provides a unique and powerful advantage that TTD and Google cannot replicate. Competitors know what consumers watch or what they search, but Pinterest knows what they plan, the desire, the aspiration, the intent. That first-party intent data is unique and incredibly valuable for targeting.
I agree that the intent data is their edge, but the complexity of this solution seems to negate the advantage.
Not if they can achieve what is often called the holy grail of advertising, closed-loop attribution.
What does that mean for the average advertiser?
It means proving deterministic ROI. Previously, advertisers saw a pin, but they couldn't definitively trace that viewing moment to an actual in-store or online purchase. By combining Pinterest's first-party intent data with TV Scientific's deterministic cost per outcome or CPO CTV platform, a platform where advertisers only pay when a desired outcome, like a sale, is achieved, pins can finally close the attribution loop. They can prove for the first time that viewing an ad on CTV led directly to a purchase inspired by a pin. This is precisely what CPO advertisers demand in a tightening economy. This fundamental capability is why institutional players like Victory Capital are buying aggressively. They see the 2026 turnaround thesis.
That's a compelling argument, and the technical merit of closed-loop attribution is high. But we have to consider the long-term drag on shareholder value from internal capital structure issues. Have you considered the continuous dilution from stock-based compensation, or SBC, which acts as a silent split, constantly eroding shareholder value?
Hold on, define silent split for us.
Sure. SBC is simply compensating employees with stock instead of cash. And while it preserves cash flow, it constantly increases the total number of shares outstanding. So you can think of it like a persistent, slow-motion inflation of the share count, which makes the remaining pieces of the profit pie smaller for existing shareholders. Even if GAAP net income looks good, the continuous share issuance depresses the per-share value and makes it harder for the stock price to climb sustainably.
I acknowledge that dilution is a pressure point, but the company has an authorized share buyback program specifically designed to offset that SBC pressure. They are, cognizant of the dilution issue. Furthermore, the valuation is just too low to ignore.
The valuation is low because the investor base is mixed, which indicates deep disagreement over which category PINS even belongs in. While Victory and Balyasny are buying, likely viewing it through a quantitative value lens, high-profile growth funds like T. Rowe Price and Amundi are selling aggressively. Amundi reduced its exposure by over 85%. This indicates what we call growth manager capitulation. They are moving out because PINS is transitioning from a high-growth stock category to a low-growth value category, and that justifies the multiple compression.
I think the multiple compression is exactly what defines the opportunity right now. At 15x to 20x forward earnings, PINS trades at a growth at a reasonable price or GARP valuation. For a profitable platform that boasts 600 million monthly active users, that valuation is incredibly attractive. GARP means it's growing faster than a typical value stock, but it's trading cheaper than a typical high-growth tech stock. Sophisticated investors recognize this arbitrage. They compare PINS favorably to high flyers like Palantir, which had significantly less profit according to recent research, yet commanded a vastly higher market capitalization. That suggests a fundamental mispricing that institutional accumulation is trying to correct.
But the constant pressure on the growth narrative, coupled with the instability of the CPG ad vertical, justifies this lower multiple. The structural factors, the competitive pressure, the integration risk, the macro headwinds are currently more powerful drivers than the promise of 2026 CTV revenue. The fact that the stock dropped over 15% post-earnings on a minor miss shows how fragile the market's trust is. The technical pinning may keep the stock from collapsing further, but it doesn't give it permission to run until the fundamentals prove the acquisition is bearing fruit.
So, my assessment remains that the overwhelming evidence points to external mechanical forces, specifically options-related hedging volatility and macro-driven guidance fears, temporarily suppressing the stock price below its intrinsic strategic value. Once that options-related volatility clears and the systematic institutional accumulation, which is confirmed by our dark pool forensics, and the shift toward value-focused ownership continues, the underlying strength of the TV scientific strategic pivot will allow the stock to re-rate. I believe the price is destined to move significantly higher, eventually toward that 39.71 average analyst target.
And I just disagree on the trajectory. The price action at $26 is a necessary corrective measure, reflecting genuine structural risks, the weakness in the CPG advertising vertical, and the substantial execution hurdles facing the CTV integration. While a technical floor is established by the options mechanics, the structural ceiling is defined by competitive friction and the very real possibility of integration failure or slow adoption. The material really emphasizes that we must differentiate between temporary technical noise and critical, enduring fundamental business challenges.
Ultimately, the future trajectory hinges entirely on whether management can successfully execute the integration, monetize its unique user intent data, and definitively close that deterministic attribution loop.
Exactly. That successful outcome, when and if it occurs, will be the final clarifying event telling us whether the $25 to $27 corridor was indeed a deeply valuable zone of accumulation for astute investors, or simply the next plateau on a path of multiple compression driven by poor execution. The data offers strong evidence-based arguments for both interpretations, requiring the listener to carefully weigh that strategic opportunity against the execution risk. There is certainly much more to explore in this material as we approach that critical 2026 deadline.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.